Welcome to our channel UpThoughtz, great thoughts and things for life. Warren Buffett is one of the most successful investors in the world. He was born in Omaha in the year of 1930, Nebraska, and he is often referred to as the Oracle of Omaha due to his exceptional investment principles. His investment philosophy is value-oriented investment approach. Over the years, he has generated significant wealth for himself and his shareholders through his successful value investment method. Here are some of the top quotes by Warren Buffett on investing and financial success. Quote number 1. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Quote number 2. Only buy something that you'd be perfectly happy to hold if the market shut down for 10 years. This quote stresses the importance of making long-term investment decisions. It involves investing in high-quality assets, choosing strong fundamental companies. Quote number 3. Price is what you pay. Value is what you get. The price is actual cost you pay to acquire an asset, such as a stock, bond, real estate, etc. But value is the inherent worth of the asset. It's the assessment of what the investment is truly worth, considering its underlying fundamentals, potential cash flows, quality, durability, and growth prospects. Buffett's investment strategy is to find the undervalued assets. Those prices are significantly lower than their intrinsic value. Quote number 4. Whether we're talking about socks or stocks, I like buying quality merchandise when it is marked down. Buffett emphasizes the importance of quality of the companies. Goods we purchase. Always seek for high-quality companies with strong fundamentals, competitive advantages, and robust financials in the stock market. Quote number 5. If you aren't thinking about owning a stock for 10 years, don't even think about owning it for 10 minutes. It means we should always make investments decisions in stock market based on deep understanding of the company's fundamentals, competitive position, and potential for sustained growth over a longer time frame. If the companies or investments do not meet these criteria, then we should not even consider the stock for short-term holding or speculation to avoid loss. Quote number 6. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. This quote is about buying a very good company with strong fundamental and potential growth at reasonable price than buying an average company at a very low price. Quote number 7. I will tell you the secret to getting rich on Wall Street. You try to be greedy when others are fearful, and you try to be fearful when others are greedy. Buffett's advice is investors should go against the market sentiment. When others are overly fearful and selling investments, it's an opportunity to buy good quality assets. On the other hand, when the market is uptrend and prices are high due to greed-driven buying, it might be a time for caution. Quote number 8. Opportunities come infrequently. When it rains gold, put out the bucket, not the thimble. In financial markets, the investment opportunities are rare and don't come very often. When such opportunities do present themselves, it's essential to recognize their potential value and start accumulating assets. Quote number 9. The most important thing to do if you find yourself in a hole is to stop digging. This Buffett's quote explains, when we are in loss, we must cut the loss to avoid further damage to our wealth, investments, portfolio, etc. It is about halting further losses, avoiding compounding errors, and taking corrective action. Quote number 10. Someone's sitting in the shade today because someone planted a tree a long time ago. This quote is about long-term perspective of investments, emphasizing the importance of making investments, whether financial, educational, or otherwise, that might not yield immediate rewards but will contribute to future benefits and success. Quote number 11. Risk comes from not knowing what you are doing. Understanding the nature of an investment, its market, risks, and potential returns allows for better decision-making and risk mitigation. Being informed and knowledgeable in the area reduces the uncertainty and, consequently, the risk involved. In financial markets, always risk of an investment arises mainly due to insufficient knowledge about investment decisions. Being informed about markets, investments, and having adequate knowledge in the area reduces the uncertainty and, consequently, the risk involved. Quote number 12. Diversification is protection against ignorance. It makes little sense if you know what you are doing. Diversification is an investment principle, involves spreading investments across various assets to reduce risk. It's a risk management strategy to protect the risk involved in the investment portfolio. Thank you for watching this video. Please subscribe our channel UpThoughtz for more updates.